We have always heard a story repeated over many years. Bitcoin is digital gold, a safe haven, a solid shield when the traditional financial system trembles. But recently, a very interesting paradox has been unfolding. When the market truly faces risk and begins to panic, this safe haven becomes the first thing to be sold off. Why is that? Today, our task is to decode this paradox. That is the very core of the entire issue. The price collapse or the disastrous sell-offs we witness do not originate from technological failure. The network does not crash. The source code continues to run perfectly. The blockchain keeps producing blocks steadily. What has truly shattered is the collapse of an illusion, or more precisely, the bankruptcy of a media narrative. When the traditional financial system opened its doors and brought this asset deep into the complex structures of Wall Street, it was precisely the plumbing of that system that completely reshaped how it responds to shocks. It was originally born to stand outside the system, yet in the end it was assimilated by that very system. And that is the objective of today's deep analysis. We will not discuss boring green and red price charts or make future predictions. Instead, we will go underground, dissect the hidden operating mechanisms of Wall Street to clearly understand the true nature of this so-called digital scarcity, a structural perspective rather than a speculative one. Let us unpack the issue. There is one detail that makes people pause. The term digital gold is, in fact, not an innate characteristic. It resembles a clever marketing campaign designed with far greater sophistication. The concept of digital gold creates an extremely accessible psychological bridge for traditional capital flows. Look at the core incentives of ETF issuers like BlackRock, Fidelity, or Grayscale, the true giants of Wall Street. Contrary to what many people think, they do not care whether the price goes up or down next week to capture spreads. The only thing they care about is AUM, assets under management. Their management fees are extracted as a percentage of this enormous pool of assets, ranging from as low as 0.15%, like the Grayscale Bitcoin Mini Trust Fund, to 1.5 to 1.0%, like the old GBTC Fund. In other words, for this fee printing machine to operate smoothly, they need investors to bring money in and lock it there and absolutely not withdraw it, and to persuade retail investors to hold tightly through turbulent waves. There is no story more effective than assigning it the image of a long-term store of value or digital gold. But the greatest underlying contradiction lies precisely in the way these funds are optimizing profits through the back door. Data from 2025 points to a very interesting reality revenue from securities lending. The technical term is securities lending. Of global ETF funds is reaching record levels. To put it plainly, on one hand, they promote to retail investors that this is a safe haven, advising everyone to buy and lock it away. But on the other hand, they lend out those very safe haven assets to market makers and hedge funds. They lend them to earn interest, while the borrowers use them to short sell and profit from volatility. For the ETFs, this is simply an additional revenue stream to offset the increasingly fierce battle of cutting management fees. But for hedge funds, they are playing an entirely different game, a game of enormous leverage. They have no concern whatsoever for a 10 or 25-year decentralized vision. Data from the U.S. Securities and Exchange Commission at the end of 2024 revealed that hedge funds were holding nearly $18 billion in Bitcoin ETFs. But the majority of this massive sum does not represent conviction in the asset. They are executing an extremely common strategy called the basis trade. To clarify this concept for those who do not work inside the tall buildings of Wall Street, it is like finding an item in the market today priced at $10 and seeing a contract that allows you to definitively sell that same item next month for $11. You buy it and immediately lock in that $1 profit. Whether tomorrow the market crashes to $5 or soars to $20, you do not care because the profit was guaranteed the moment the order was executed. An extremely accurate comparison. Hedge funds buy spot ETFs in the market, while simultaneously shorting futures contracts. They capture the risk-free spread in between. This return can steadily pocket 5% to 12% per year, an extremely attractive yield for a trade with virtually no directional risk. What is the core issue? That $18 billion is merely mercenary capital. It stays there only as long as the spread remains lucrative. The moment that margin narrows or borrowing costs spike, these funds will close their positions in unison. They will mechanically dump their holdings onto the market without hesitation. And the consequence is that retail investors, those who believe in the digital gold slogan and buy to accumulate, become the ones standing at the front of the storm-tossed ship. The media has painted an overly simplistic picture, obscuring the hidden risks stemming from these massive mechanical capital flows. What I find most ironic is the way the system classifies this asset. Why something designed to become a protective shield has been transformed by the financial system into the most fragile spear. What is compelling here is that we need to clearly understand Wall Street's concept of risk classification. When a massive fund manager constructs a balance sheet, they never place Bitcoin into the safe asset basket alongside US Treasury bonds or physical gold. It is placed directly into the risk bucket, meaning the high-risk asset group. It must sit at the same table as the most high-flying technology stocks, or the most speculative assets in the market. In other words, in the eyes of fund management, algorithms, Bitcoin, and a cash-burning software stock are no different. And when a macro shock occurs, how do these computer systems react? The document mentions a mathematical model that governs everything called value at risk, abbreviated as VAR. Without using complex equations, we can understand VAR as an automatic red alarm system of a ship. It measures the maximum loss that the entire investment portfolio can withstand before everything collapses. The fatal vulnerability of the VAR formula lies in a variable called sigma, representing volatility. When a macro shock hits panic spreads and causes the volatility of all assets to spike. But this asset inherently already has volatility 3 to 4 times higher than ordinary stocks. To save the entire portfolio, the red alarm system will automatically activate. It will automatically press the liquidation button on whatever is pushing the overall risk level the highest. Because it sits in the highest volatility risk group, this is always the first name brought to the chopping block. This sell-off behavior is entirely mechanical, cold, and automatic. The computer does not know whether this is digital gold or a grand, decentralized network. It only sees a string of numbers threatening the fund's risk limits, and it dumps. And this is where it becomes truly interesting. The consequences of this integration are reflected in extremely clear numbers. If we look back at history for a moment before the ETF era, meaning from 2020 to 2023, Bitcoin was still like a nomad wandering in the desert. At that time, its volatility was around 4.2%, and most importantly, its correlation coefficient with the S&P 500 index was extremely low, below 0.2. It moved entirely along its own path. But since entering the plumbing of Wall Street, during the 2024 to 2025 period, everything has been reshaped. The average daily volatility fell to around 1.8%, yet its correlation with the S&P 500 jumped to between 0.5 and 0.7. This phenomenon is referred to by experts as correlation architecture. It does not mean that the nature of the source code changed. It means that when this asset shares the same liquidity stream as the stock market, sits on the same balance sheet, and is governed by the same leverage system, it is forced to share the same fate. Integration has brought tens of billions of dollars in capital inflows, but the price paid is that it becomes fully synchronized during moments of market panic. If that is the case, then has the entire hedge label all along been meaningless? If, at the worst moments when protection is needed most, it is sold off disastrously and tightly correlated with the collapse of the stock market itself, then what purpose does it ultimately serve? Could it be that those who bought it for defense are all being deceived? This is a very excellent question, and to answer it fairly, we cannot look only at the moment of panic. I will provide an extremely deep macro perspective through the 5-stage liquidity cycle. Very few people in the market are patient enough to view it through this lens, so let us dissect each stage one by one. The first stage is the shock, an unexpected macro event, such as surging inflation war or a banking crisis. Immediately after that comes stage 2 liquidity tightening. This is when people panic, financial institutions crave cash. They sell indiscriminately anything that can be sold just to bring dollars back. When cash is needed, most something highly liquid like Bitcoin becomes the first victim to be dumped onto the market. It suffers most severely precisely in this second stage. Next is stage 3 broad asset collapse. Stocks, real estate, everything plunges. But this is when the cycle begins to turn at stage 4 policy easing. Central banks realize the economy is on life support, so they are forced to intervene by cutting interest rates and printing money aggressively to inject blood into the system. And that leads to stage 5 liquidity expansion. This is when the real magic happens. There is a statistic that deeply impressed me after inflation shocks from the Producer Price Index PPI within the first 120 days. Bitcoin's average return is negative 25.8%. Meanwhile, traditional gold proves extremely resilient, performing exactly as a safe haven in the storm, moving sideways or rising slightly. But when entering stage 5, when new money floods the market, the story reverses completely. That is why we must redefine the role of this asset. Do not call it a hedge against economic catastrophe. It is, in fact, a hedge against money printing. A technical term for this is liquidity beta. That is the total amount of cash and deposits circulating in the economy. If the central bank prints more money and causes M2 liquidity to increase by 1%, then Bitcoin, due to its sensitivity, has the potential to surge by 3% to 5%. It acts like a gigantic sponge, absorbing and amplifying the expansion of global money supply. This explains its astonishing resilience. Even after enduring harsh winters, losing 70 to 80% of its value, its rebound speed is unprecedented. If we look back at history, a stock index like the S&P 500 may take more than 15 years just to crawl back to its previous peak after the dot-com bubble burst. An excruciating waiting period. Yet this asset often recovers what it lost and sets new highs in less than 2 years. The deeper reason lies in its completely inelastic supply. When the storm passes, the forced selling pressure from leverage has been exhausted. It only takes a small spark of renewed demand, and absolute scarcity will push the price upward exponentially. Instead of using the name digital gold that causes so much misunderstanding, perhaps we should call it digital hypervolatility with limited supply. A long name, but far more accurate. If we connect this to the broader picture, we need to place this process within a greater evolutionary lens. Safe haven status has never been a privilege granted at birth. Gold did not naturally become a refuge. It took thousands of years of history, enduring countless wars and trade agreements, to embed itself into the core reserve system of humanity. Meanwhile, Bitcoin is only 15 years old. Demanding that a 15-year-old asset remain calm and steady, like a metal that has existed for 5,000 years, is a cognitive injustice. To truly become a safe haven, it needs time to pass through the system's thresholds of acceptance. In other words, milestones of institutionalization. And if we look at the broader picture of 2025, we are witnessing extremely solid steps crossing those thresholds. Most concretely is the participation of pension funds, an extremely important milestone. These are institutions representing aged, slow-moving capital, but demanding the highest level of safety. The Investment Board of the state of Wisconsin has allocated more than $300 million, And the pension fund of the state of Michigan has also appeared with approximately $6.6 million. Although these numbers are very small relative to their total assets, their structural significance is enormous. Research indicates that even an ultra-small allocation, for example around 0.5%, from these gigantic pension funds is sufficient to create an extremely solid price cushion for the market. The reason is that when the market plunges, these funds are not driven by panic. Their portfolio rebalancing algorithms will automatically detect that the allocation has fallen below the 0.5% target and trigger buy orders to compensate. An automatic and price-insensitive buying force. This passive buying action invisibly creates a massive support force in lower price zones. The attachment of this capital flow is what reshapes the structure of the price floor. We observe this phenomenon entirely through the lens of data and financial structure, without evaluating or judging the political stance of any country. Data shows that a national bank has begun an experimental move by purchasing $1 million. Their purpose is clear: not to speculate on short-term price swings, but to build infrastructure, train national private key management procedures, and establish anti-money laundering systems. Then we have El Salvador with approximately 7,500 Bitcoin held in reserves. But certainly all eyes are focused on the explosive event that took place in March 2025, the move of the United States to establish a Bitcoin reserve, a strategy beginning with the legalization and management of the enormous volume of confiscated assets. But the intention to move toward direct purchases and officially place it onto the national balance sheet has completely changed the global rules of the game. It marks the moment Bitcoin transformed from a financial instrument of speculators or a technological experiment into a genuine geopolitical competitive tool. Consider the game theory behind this move. If a superpower begins accumulating an asset with absolutely limited supply, it immediately creates a FOMO effect, the fear of missing out at the national level. Other countries in Europe or Asia will be forced to weigh the risk of not owning this asset, a risk that is too great. In an increasingly digital world, standing outside the game could be viewed as a strategic vulnerability to a nation's financial security. That is the moment when true safe haven status is formed, when an asset is anchored firmly onto the balance sheets of pension funds. And into the vaults of central banks around the world, stability will arrive naturally. It is a process of irreversible integration into the structure of global financial power. So, what does all of this mean? A genuine analytical journey has opened up many new perspectives. We moved from exposing the illusion of Wall Street's digital gold marketing narrative to understanding how automated computer systems mechanically crush this asset in moments of panic, to dissecting the truth about a hedge against money printing, and finally, to witnessing its evolution into national reserves, a truly spectacular transformation. In summary, it can be said that the original rosy story has been shattered by reality, but the fundamental strength of the network has not disappeared. Stripping away that mythical outer shell is in fact a wonderful thing. It forces us to view the world with clearer eyes, to recognize a finite asset that is extremely sensitive to the liquidity cycle and is gradually infiltrating every capillary of the financial system. The greatest lesson is not to fear or flee from volatility, but to always ask ourselves, which stage of the liquidity injection and withdrawal cycle are we standing in? This raises an important question, and also a deeply contradictory future scenario. The macro report offers a projection that if this path of integration continues, and one day its market capitalization reaches a scale equivalent to that of gold today, approximately $13 to $15 trillion, then that enormous mass itself will function as a machine anchoring stability. Violent volatility will disappear, and at that point it will truly operate according to the definition of digital gold. But consider this. If it truly becomes flat, stable, and safe like gold, will it lose its liquidity beta, the massive upside sensitivity that made Wall Street's smart money and investors crave it from the very beginning. Could the highest price of becoming a perfect safe haven be the loss of its own superpower of amplifying returns? A final provocative paradox, worthy of deep contemplation. Perhaps maturity always comes with the loss of a portion of one's original wild identity. We will leave that open question for curious minds to contemplate on their own. Thank you all for accompanying me in today's deep dive exposing complex financial lenses. The truth has never been simple slogans. It always lies hidden beneath underground pipes, and our task is to continuously dissect them. See you again in the next intellectual exploration journeys. I wish everyone to always maintain a cool head and independent thinking.